We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Rubino, former Wall Street financial analyst and publisher of the Rubino Substack with over 20,000 subscribers. John, thanks for joining me today. How are you?
Hey, Tom. It's good to talk to you again.
Absolutely. John, I'd like to start today's conversation by asking you, how do we frame this current time in your eyes? Are we headed for hyperinflation, deflation, stagflation? What flavor of Flation are we headed for right now?
Well, we're at the end of a credit supercycle that began, depending on your point of view, in 1913 when we founded the Fed, or 1971 when we went off the last vestiges of the gold standard. And either way, really long time, massive amount of imbalances have been built up. And so chaos is kind of unavoidable. And we're kind of entering the death spiral part of the process where the world's fiat currencies start to blow up on us. And it's very hard to predict exactly how that's going to look, right? Because these are, this is global, first of all, where currency crises used to be country specific. One country would screw it up and have a collapse and have to go back to the gold standard. But everybody else was on the gold standard while that happened. This time around, it's different because everybody has a fiat currency. Nobody is on a commodity-based financial system or anything, that relates their currency to something real. And that means it's going to be much bigger when this thing blows up and much more varied. There are all kinds of things that can happen, from war, which we just barely avoided in Ukraine here. We were almost in World War III, to hyperinflation, to deflation. Anything can happen when something like this really starts to go. And the highest probability, though, scenario is that interest costs start becoming debilitatingly high for governments now because they build up so much debt and they have no choice but to really dramatically inflate away their currencies. And that leads to prices going up and currency values plunging. And in other words, we get something like 2022 when we had double-digit inflation in the US for the first time in a generation, only on steroids, much bigger, much more chaotic. And in the financial markets, it's hard to know whether that's good or bad for stocks in general, right? Because they're financial assets, which should be really debilitated by the kind of currency crisis that we're heading for. But at the same time, inflation makes the price of lots of things go up, including stocks. So the stock market might do well, or it might not do well. But what probably will do very well is real assets while all this is going on. In other words, energy assets and precious metals like gold and silver and uranium, things like that, farmland, things that governments can't make more of out of thin air, will tend to do really well amidst the chaos. And but it will be chaos, political, maybe geopolitical, certainly financial. All of that stuff is coming as we try to deal with all the debt that we've taken on that we cannot pay off to save our lives now.
Does a lot of this right now depend on the oil price as well, John? You mentioned that in your answer there, and we've seen a recent slide in oil prices. So how big of a component of this is the energy price right now?
Well, as Doomberg likes to say, energy is life. And so the oil price is hugely important because it's in everything. If you're a farmer, that's very energy intensive. You need to probably put petrochemical related fertilizer on your crops, and then you need to run gigantic machines in order to harvest the crops, and then you need to transport the food to grocery stores. So the food system, which most people focus on when they think about inflation, is hugely energy intensive. So if oil prices go down, that's deflationary. And oil, being a cyclical market, tends to go down during recessions. So we're kind of heading into a recession. So it wouldn't be a surprise to see the economies of the world slow down dramatically and energy use drop. And at the same time that the U.S. is producing more and and OPEC is producing more oil, and so we could see oil drop dramatically, although it has already dropped from 80 something to 60 something in just the last year or so. But it could drop more from here, and it could be structurally low for a while just because of massive supplies. The U.S. Under Trump, but even before Trump, was becoming an energy gigapower. We were making more and more of every kind of fuel source. And we're not going to slow that down at all. It looks like the Trump administration intends to turbocharge the process of getting more oil and coal and natural gas and maybe uranium. So that could lower energy prices for a while here. And that could give us what looks like deflation in the next couple of years. So here's one scenario as that plays out. We have a recession. Energy costs go down, especially during the recession. So that, it could be that we even have zero inflation for a little while. And that spooks the central banks of the world big time, because you cannot have deflation in an over-indebted system. So they will panic cut interest rates. And we'll go back to where we were for a while there, when like 1/3 of the debt in the world had negative yields. And we go back to that, but maybe, again, on steroids, maybe even more so. And that, in turn, becomes inflationary, because it makes the currencies of the world worth less and less as interest rates drop into negative territory. So we have a period of slowdown, recession, maybe deflation, followed by a burst of inflation because interest rates are being pushed down to naturally low levels again, and governments are running big deficits to lean against the recession. And maybe that's it. Maybe that is the death spiral for the world's fiat currencies, because we're working with massively more debt now than we did in the Great Recession. And it could be that that's just too much debt to inflate away without just blowing up the world's currencies. And so we finally get the currency reset that Jim Rickards has been talking about for a while. And then it becomes a really interesting debate about what form that should take. Is it going to be a Bitcoin standard, or will we go back to a gold standard? Because it's understandable, and the world central banks are kind of leaning that way anyhow by buying huge amounts of gold lately. Or do we go to some other kind of commodity-based standard that's a mix of different things like oil and uranium and coal? I don't know. I think we'll debate where we go when we start thinking in terms of a currency reset, a new Bretton Woods agreement. And I suspect it's probably going to be a new gold standard, because that's understandable. Whereas all this other stuff is kind of a leap into the unknown, a leap of faith. And the last thing we will have during a major currency crisis is faith in our ability to figure things out, or anybody else to tell us the truth about any of this. So we'll probably go for something that is understandable and that has already existed. We had a gold standard for 200 and some years, and for the best part of it, it was called the classical gold standard. That's how we refer to it now, because it really worked. The monetary system of the world was very stable. We actually had modest deflation each year as workers got more productive. And we had massive investment around the world. We had kind of a globalized system back then, where basically anybody could invest anywhere, because everybody was on the same currency standard, in effect, by linking their currencies to gold. So we could point to that and say, well, let's just do that again, and a lot of people would get on board when things are especially chaotic. So we'll see. But I mean, as a gold bug, that's the best scenario for me. I would love to see what price they come up with for gold when they start really running the numbers, to see what price gold has to be to fully back a world of tens or hundreds of trillions of dollars of paper money floating around out there.
John, I want to go back to this idea of, a possible deflationary scenario. How much of let's say, a counterbalancing force could the reshoring and tariffs be as a ballast to the deflationary trend of the lower energy prices and recession?
Well, that is inflationary because it's expensive to take a factory that is running in China right now, let's say, and relocate it to Tennessee. That's inflationary two ways because we have to buy a lot of raw materials and hire a lot of people to build a big factory, and then we have to employ a lot of people at good union wages that will be orders of magnitude higher than what people make in some other parts of the world. So we would probably get an element of wage inflation in this scenario. And this is a real scenario. It's coming. Lots of companies around the world are relocating factories to the US. So this is happening. And if we're going to hire enough people to run these big chip plants and these natural gas refineries, things like that, we'll have to pay up, right? Because right now there aren't probably enough people in the US who have those skills. So we got to educate them and then we got to pay them really well. So we'll have wage inflation. And the Fed hates wage inflation because, they don't care if stocks and bonds and real estate go up because that enriches the people who own the Fed and run the Fed. So they call that asset prices rising, but they don't count it as inflation. But if a bunch of guys who are working at Walmart right now go over to a chip plant and get 3 times as much money, they call that wage inflation and they consider that to be a bad thing. So the Fed will be under pressure to raise interest rates because of that. But they'll also be under pressure to cut interest rates because of all the financial insanity that's happening when the US government interest costs on its debt start approaching $2 trillion a year. That's a catastrophe. And the Fed is aware of that and watching it. So they want lower interest rates. And everybody else wants lower interest rates too. Remember, we have a real estate developer as the president now. And real estate guys love low interest rates. So he's going to be publicly pressuring the Fed to cut interest rates. So did I mention chaos? Yeah, that's what ensues when you've got wage inflation rising and commodities, or at least interest costs rising to the point where interest rates have to be cut, according to basically everybody. We'll see what they do, but these are going to be very powerful countervailing forces. Mm-hmm. And it's going to be incredibly messy because, if you have wage inflation that pulls overall inflation up to 5%, let's say, which is totally conceivable in that kind of a world, that means your currency lost 5% of its value that year. So you've got inflation that, if it continues at that rate, will threaten to become disorderly and just currency falls off the table. So you get, the crack-up boom for the Austrian School of Economics, where everybody just gives up on the currency. And that's a real danger. Mm-hmm. But at the same time, you can't raise interest rates to protect your currency without causing interest costs for all the world's major governments and a lot of big corporations from going through the roof and just blowing up all these systems. So we're in a box that we can't get out of at that point. And, the specifics of it are completely unpredictable because all of that stuff is huge. Each one of the components of the chaos that we'll be looking at are headline news. And something that economics books will be written about, and they're all going to be happening at once. Mm-hmm. So again, as individuals, we have to kind of figure out how to protect ourselves and our families from this kind of chaos, and you do that with real assets. So, and all right, to digress into politics a little bit. I really like a lot of what the Trump administration is trying to accomplish here. And the idea that they're going to be engulfed in this chaos is a really bad thing. There wouldn't be poetic justice in any way because they didn't cause the problems that they're having to deal with right now. So hopefully they'll be smart enough to do a currency reset sooner rather than later. Just get it out of the way. Put up with the short-term trauma that it causes, and that's not a pipe dream because Trump has a lot of people around him who sound like gold bugs. He's got people talking about, we'll issue 50-year bonds backed by gold, or we'll do something else like that. And, you get those guys into a room in a really chaotic time, and maybe they come out with a new gold standard where they just say, okay, from now on, the dollar is just a word for 1/10,000th of an ounce of gold. And then they go on from there, and that wouldn't be pain free because everybody who trusted the government would be screwed over by that monumentally. But it would let the country go forward with a sustainable monetary system. So you get through the immediate chaos and pain, and at the other end of it is something that is workable, and the other alternatives are so horrendous that it's possible that the government is willing to give up the ability to create money out of thin air in order to go back onto a system that will prevent a civil war or prevent World War III or whatever that we'd be looking at that time. So, I'm hoping, and that's a good scenario for Donald Trump. It means he's the Winston Churchill of our time, and I would love to see that if it turns out to be possible.
Mm-hmm. John, do you think that going back to this interest rate question, how bad do you think this recession would need to be to see zero rates again and money printing? Or, do you think it gets to the extreme of actually maybe even seeing negative rates, something that we haven't really seen unless you think about real rates, but we really haven't seen in the US?
Yeah, the US didn't have negative interest rates, but Japan did. And Germany did. And those are serious countries, and they went strongly negative because they were they each have different problems. Germany is terrified of financial instability because they lived through a hyperinflation. And Japan has so much government debt relative to GDP, or I'm sorry, relative to GDP and per capita, that they understand that rising interest rates are an extreme risk for them. That could just blow up the Japanese government's finances. So they both cut interest rates really dramatically. And, the U.S. is heading into a stage of their financial evolution when it's kind of like that. We cannot handle, let's say we kept interest rates at 5%, which is historically a little on the low side, right? It's not even high interest rates. It's just high for recently. We kept interest rates at that level. That means we've got $40 trillion of debt that we're going to be paying 5% of interest on. And I don't have the math for that in my head right now. I won't try, but it's a bigger number than we're currently paying. So it's more than $1.5 trillion. And it's heading up at a parabolic rate because we have to borrow the money to pay that interest, which means next year's deficit is even higher. And see, when we enter that kind of a currency death spiral, we'll be just as scared as Japan and Germany were the last time around about what's going to happen if things just spin out of control. And so there will be really strong incentive to push interest rates down and just to keep on pushing them down because, and Trump, who in general I like, has a pretty simplistic idea about interest rates. He just thinks low interest rates are great because as a real estate guy, they always were in the past. So he's liable to think that negative interest rates are great. And he's liable to put a lot of pressure on the Fed to get us down to like negative 2%. Because look, then when we borrow money, they pay us, we have positive cash flow from borrowing money. And, we'll hear stuff like that. And it's possible that we actually go that way, that we push interest rates down into negative territory as a way to be able to borrow with impunity. But of course, that means we'll borrow huge amounts and that everybody else will borrow huge amounts. And that means that we bring ourselves that much closer to the cliff that will fall off if we keep on borrowing money. Mm-hmm. So negative interest rates, even if they seem like a good short-term solution, are a catastrophic long-term policy. But when things start spinning out of control, governments get just as crazy as individuals do when they start to panic. So there's no reason to think that that's not a possibility, But there are lots of other things that could happen in the other direction, where interest rates just spike because nobody wants to hold dollars anymore, stuff like that. And that's a real possibility too. There's no real linear scenario that you can point to and say, okay, this is going to happen, then this is going to happen, then this is going to happen, because too many things could happen that point in multiple directions all at once. And there's just no way to know how it's going to play out. So you want to just be as cautious as possible. Do things that make you resilient, and do not take really aggressive risks because you think you know what's going to happen in the next couple of years. Nobody's going to know that. Some people will guess right, make a fortune, become household names, but they will have guessed, and they didn't actually know.
Mm-hmm. Well, I think it is a hard thing to be able to separate what is, what overhanging problems that Trump assumed as part of the presidency. As those come forward, it's going to be hard to separate, how those are affecting the economy versus his actual policies that he's implemented.
Oh yeah, anybody who takes power right now is inheriting 50 years of horrendous mistakes. Mm-hmm. So, and whoever's in charge always gets the credit and the blame for whatever's going on, right? So, yeah, if you're in power right now, you're staring at, a debt that is 120% of GDP just at the government level, and massive amounts of debt everywhere else in your society. And there's never been a time in human history when that wasn't debilitating in some way. It messed up countries one way or another when you have 300% of GDP in debt, and so you inherit that if you take power right now, and you inherit all the problems that inevitably flow from that. So, the guys in charge of Europe, the guys in charge of Japan, soon to be the guys in charge of Canada, and in the US, we've all got these problems that are, probably can't be solved easily and painlessly, and the guys in charge are going to get blamed for that pain. So that's just that's baked into the cake. There's no way to do this in a smooth, coherent fashion. There's only deal with the problems when they come up in a coherent, understandable way, so that people see that you're sincerely trying and you're making as good a set of decisions as is really possible in the moment. And then, then maybe you deflect enough of the blame so you're politically viable. But it's not normally how it works. Normally there's regime change. When stuff like this happens, you get kicked out of office as soon as the real stuff starts.
John, as we're discussing this idea of more currency devaluation / inflation, whatever you want to call it, this, just makes me think about more demand. On one hand, more demand, and also the comparison of gold and dollars rising as well. So, gold's run over the last couple of weeks was mostly attributed to this tariff threat. But was it surprising or very important that, let's say, precious metals were exempt from the tariff framework?
That's a good thing for precious metals to not be part of this whole thing. But, a big part of why gold had that big run was that people were worried that gold in London, when and if it was moved to the US, would be subject to tariffs. So they were trying to get the movement out of the way. New York was trying to get its gold. And you had the president and his buddy Elon Musk saying they were going to audit Fort Knox, which is probably another reason why a bunch of gold was taken from Europe back to the US, because I think it's completely possible that those vaults weren't nearly as full as they were supposed to be, and they had to be restocked before they let the president in. So yeah, gold had a really nice run as we moved into the tariff regime. And then it got smacked as soon as those tariffs were actually announced. Everything went down for a couple of days. I'm not sure whether that was the biggest drop in the NASDAQ numerically ever, but it was pretty close. That was a huge stock market bust for a couple of days, and gold and silver got sucked right down along with it. But, again, there's so much stuff going on that it's hard to attribute any one event to any one cause because there's so much happening. And, today, it looks like the tariff thing is already working out. A bunch of countries have come to the U.S. and said, well, all right, let's just go to zero tariffs each. Okay, a little sideline here. I've seen people in podcasts, and a couple of people have actually told me face to face that they ran the numbers on Trump's tariffs and that they didn't make any sense. Trump had no idea what he was doing when he came up with the numbers for the tariffs to be applied to each country. And, I suspect that was a feature, not a bug of the plan, because, Trump wants U.S. trading partners to view him as batshit crazy, right? No idea what he's doing. He's just throwing numbers out. He's going to cause trouble for everybody. And that gives them an incentive to come back and say, look, let's just do away with the whole tariff thing. We'll both have zero tariffs. And so that's his ultimate goal, is a world without tariffs, especially tariffs that disadvantage the U.S. And the tariffs that he proposed were so messy that it makes zero tariffs look like the least bad option for a lot of trading partners. And that's kind of what's happening now. You've got countries coming back and wanting to deal and bringing up zero tariffs as a possibility. And so now the stock market's going back up. And gold, at least for most of today, went back up. So it looks like normality might be returning sooner than people expected. I think a lot of people expected all these new tariffs to cause long-term chaos. And it could be that part of the story is working itself out sooner than we expected. I don't know, as we're speaking, where stocks are in the U.S., but I think they're up 3 or 4% kind of across the board, which is a really big up day for equities. So we're unwinding some of the losses of the past week.
Yeah, and we're speaking about midday on Tuesday the 8th here. And I think a big part of that is how oversold the market was. And I think it'll take maybe a week or two for this all to actually settle out, to figure out where the confidence in all of these different markets actually sits.
Yeah. And this is happening at the same time that we're kind of tipping into a recession, because a lot of stats are pointing in the direction of a slowdown, or either coming or already here, And so, okay, we got this tariff thing that caused a lot of turmoil in the financial markets, and maybe that's going to moderate, and it's going to go to a slow simmer where we're working things out with countries, and we mostly expect to eventually settle on something that's workable. But at the same time, the economy is slowing down, which means corporate profits are going to drop, which means equities, normally they're tied to corporate profits, and they're going to get whacked. So we could still be heading into an equities bear market and a slowdown, even without the tariff thing having happened. So, and I think that was probably always likely right about now, because, you look at consumer spending, and consumers have basically they've spent all the money that they got from their stimmy checks during the pandemic. And now they're, at least in the US, they're putting day-to-day life on credit cards, which means they're carrying loan balances they're charging them 25% a year, which is a recipe for personal bankruptcy. And so that's where we are in the US, and that's a recipe for a recession, basically. So that was always kind of coming. And so maybe we settle the tariff thing, but then we head into a recession and we get the equities bear market and everything that is in danger of metastasizing into something much worse. So we haven't solved anything, in other words. We still have a lot of chaotic stuff coming our way. Hopefully the tariff thing is not this big catalyst for something even worse than a garden variety recession, but we'll see. We just can't know at this point.
John, what do you think matters now for the gold price, now that, precious metals have been excluded? Has this changed the fundamental case for gold in any way?
Well, gold has had a hell of a run. in the last year. I mean, remember, it was just lately that we were talking about whether $2,000 an ounce was going to stay resistance for gold for a long time. It had been like 4 years. It bounced off 2,000 and bounced off 2,000. And then in a very short time after it pierced 2,000, it went up to 3,000. So, you could say that it's kind of overbought at this point and we need a correction. Just because why wasn't 3,000 resistance? There should have been an awful lot of profits being taken right there. And that didn't happen. So that's out there as a risk. And then a recession where equities tank and that pulls down gold and silver, which is the way the last two recessions happened, both in 2008 and 2020. Equities tanked and so did gold and silver. So that's a possibility out there. So I'm a little nervous about precious metals, especially gold, at this level, because the long-term story is totally intact. I mean, $10,000 gold will probably happen in a currency reset, and $5,000 gold is just what you would look at technically on a chart and get to without too much trouble. So the question is, what happens in the next year? And that I'm a little bit more nervous about, just because we've had such a good run already. And the oil thing that we talked about at the very start of this interview, if oil is pulled down in a recession, then that's very deflationary. And so the inflation numbers will be surprisingly low for a while. And that's not necessarily a good thing for gold. Now, having said all that, the gold silver ratio went to 100 while all this stuff was going on. And there's, as far as I know, there's never been a time when it got up to 100 and silver wasn't a really good buy at that level as it worked out over the next couple of years. So it's possible that there's a short gold buy silver story right now, and which I wouldn't recommend doing or anything, but it's one of those times when that might actually be a way to make some pretty good money coming and going. Mm-hmm. But I still think the silver story is really good. It's just, it's a market that's in deficit, and that deficit is in danger of turning into a shortage, and that shortage could lead to panic buying. And you could easily see silver go up in $10 monthly increments for a while, where you just have this phenomenal month where it goes up by this amount that nobody really expected going in. That could happen. So I wouldn't be selling silver at this point. And if it drops down into the high to mid 20s in whatever's coming, that would be a time to start buying more. And in any event, you should be dollar cost averaging and stuff like gold and silver. The smartest way to play those markets is just not to play them, just buy a certain dollar amount per month of gold and silver bullion, put it in a safe place. And that's really almost all you need to do financially, I think. All the rest of it is interesting and challenging and fun. But if you just dollar cost average gold and silver, you'll probably be okay 5 or 10 years from now.
Mm-hmm. Well, John, what happens to silver if we get this slowdown? With let's say an industrial recession, does demand for silver go down, and that production deficit per year also, ease as part of that?
Maybe. Recessions are hard on gold and silver. And you could see short-term weakness in silver as all this plays out. But with silver, I would say that's just a reason to bump up your dollar cost averaging a little bit, because the supply-demand equation could get a little bit less dire than it is right now. But still, solar energy is a growth market regardless. And every solar panel uses a little bit of silver. And electric cars, these things, their sales could go down a bit, or their sales growth could slow, but they're probably ideas whose time has come. And so that's going to be a continued source of demand for silver. And then in the military, unless we do that thing Trump was talking about where everybody cuts their military budgets in half, that would be very cool. But advanced missiles and microchips use silver, and the military still has a big demand for them. And, investors, when part of the reason why 90 and 100 and a range like that for the gold to silver ratio is so good for silver is that individual investors start looking at, okay, here, there's a crew grand. I have to pay this much amount for that crew grand right there. But look how many silver ounces I get for that same amount of money. And they envision this big pile sitting on a table, and it's gorgeous. And, they can use it at the farmer's market or wherever because it's low denomination money. And so people start buying silver because of the difference between silver and gold. And that usually kicks in towards the bottom of recessions, because silver will go down more than gold in a downturn, which raises the gold to silver ratio, and then people start looking at how much they can get, how much silver they can get for an ounce of gold, and then they start buying it, and then silver spends the next few years outperforming gold. So yeah, if silver goes down in the next recession, then you've still got that to look forward to, which is a reason to be a buyer down at the bottom. So, again, no guarantees about anything. There are so many different potential scenarios here, but some of them are really favorable for people who are trying to become resilient. And those are the ones we should be paying the most attention to.
Mm-hmm. You mentioned this demand for silver coming from individuals because of this, gold to silver ratio and that imagined pile comparison there. What do you think brings investment advisors to the table?
Well, that's already starting actually, because gold mining stocks tend to outperform the metals during a metals bull market. And so what's happening right now is you've had gold stocks do pretty well for the last 6 or so months, which means a lot of financial advisors have their clients coming to them and saying, hey, I keep seeing gold everywhere, buy me a gold stock, and so the financial advisor doesn't even know any gold stocks, really. So they look it up and they find Newmont or Barrick or something like that, and they put their client into Newmont or Barrick. And then gold goes up a little bit more, and more people come in, and the financial advisor says, well, who else is good in that space? And so they start working their way down the food chain. And so you get generalist money start to move into precious metals via that mechanism. And that just makes precious metals miners go up even more, which sends more clients into these financial advisors. Because right now, the 70-some% of financial accounts have no gold and silver in them. No precious metals related asset of any kind. So that means there's a ton of people out there who are a little bit pissed at their financial advisor for not putting them in this thing that actually, and there are all these charts of gold outperforming the S&P 500 in this century and stuff. Mm-hmm. And so people are wondering why they have all these S&P 500 ETFs, but they don't have any gold, and gold did better than the S&P 500. And so you get kind of a snapback reaction where money managers just paid no attention to precious metals at all, and now they kind of have to overdo it a little bit to show that they're cool, that they're able to find new assets that have done well, and so maybe from 1%, those accounts go up to 3% of gold and silver, which is still minuscule. That's still nothing, but that amount of money flowing into gold and silver would send them through the roof, because those are tiny markets compared to tech stocks and financial stocks and government bonds. They're dwarfed by the mainstream markets. And so that process usually happens in the middle part of a precious metals bull market. And then it peaks after gold and silver have peaked, because people are still jumping into it. They're buying the dip at the peak, and so you still get some really nice moves in precious metals miners up there at the top of the cycle. And we're just beginning this part of the cycle, where generalist money is sort of starting to pay attention, and they're buying GDX or Newmont or something like that. And it hasn't worked its way down to the smaller players yet. So the real action is the last 2 years of the process, like 2010, 2011, last time around, when you just had gold and silver stocks just rock. And that day is coming, and that's how it will work. When the generalist money starts pouring in because of momentum, then that's when you'll want to be kind of selling some of your stuff to those guys, but we're nowhere near there yet. So continue to dollar cost average and only start selling later on when it becomes kind of a frenzy.
Mm-hmm. John, when we think about, this ecosystem of gold miners, explorers, developers, where do you focus what you're going to be putting your money in?
Well, everything in the space has its appeal. The big serious gold miners, for instance, are generating massive cash flow with gold at this price, right? Not surprisingly, most gold mines have been greenlit at $1,500 gold assumptions. And now gold is twice that high. That means that profit margins are much wider than were expected when these mines were greenlit. And so these big miners have tons of cash now. And they still remember being burned by the last time they overdid it with acquisitions and stuff. So at first, they're raising their dividends and they're buying back stock. And that's good for shareholders. That's a really nice profile for a big, solid stock that you own. They're paying you a higher dividend and they're taking stock off the market. And so that's the appeal of the big guys right now. And the mid-tiers in precious metals are looking like great acquisition candidates right now, because the big miners, even though they're paying off their debt and they're raising their dividends, et cetera, they are still running through their reserves more quickly than they're finding new reserves through their own exploration efforts. So they need to avoid just being zeroed out by using up all their reserves and ceasing to exist by going out and getting reserves somewhere else. And right now they're cautious. So they're looking at the established junior miners and emerging miners with who are way down, way advanced in the process of making a mine. So they're buying them. And that's the appeal of that group, because they're good acquisition candidates. You see the big guys step up and pay nice premiums for their stock. Mm-hmm. Now, way down at the bottom is the explorers. And 90% of them are going to go out of business with never earning a penny. But the 10% that actually are discovering serious deposits, the kind of thing that can move the needle for Newmont, they're still not really on the radar screen of the big guys to an extent yet, because the big guys are focusing on the safe plays, the mid-tiers and everything. But there will come a time when the market is rocking so dramatically that the big guys start buying out the little guys, the very little guys. And a lot of these little miners are really cheap relative to the gold that they have in the ground or the silver. So they'll be bought out at big premiums. And you might have there's your 5 baggers and your 10 baggers in that space. And that, it hasn't really started happening yet on any scale, but at some point it will. So maybe it's at the, year 3 of the next downturn where we're coming out and everybody's really excited about everything. Or maybe it happens sooner, because the next few quarters of earnings for these big companies are going to be really spectacular. They're selling $3,000 an ounce gold right now. So they're going to make a lot of money and they're going to report really good earnings. And maybe that's the thing that kind of burns a hole in the pockets of the CEOs of the big guys. And they start buying up the explorers at an aggressive pace. No way to know the timing, in other words. But when it happens, the explorers are the place to be, because even the crappy ones are going to go way up because of the generalist money. Generalist investors are going to see some spectacular takeouts happen, where some little miner goes up by 300%, and then a big miner steps in and buys them for another couple of 100%. And the generalist money is going to want that action, and they're going to buy anything that says gold and silver in the title of the company. Mm-hmm. So the beaten down explorers that really aren't finding anything that would move the needle for any big acquirer will go up even more sometimes than the high quality explorers, because the high quality explorers have already been discovered and they're reasonably high, and the other ones have been beaten down and nobody's paying attention to them. So there's your 5 baggers or 10 baggers, although I don't recommend investing in crappy companies under any scenario, but that is the way it usually goes in this market. The names that shouldn't even exist become 3 or 5 baggers or something like that, and that gives them a chance to survive, because then they can raise money. But if the property they're exploring is just never going to make it, then they're going to waste that money too. So that's a thing for us to talk about when that really gets going, and maybe name some names of the quality explorers that you can get into reasonably safely and avoid the rest. But you want to be there when that happens, because it's just, for a year, it's easy money. It's just everything you own in that space is going up. And if you're kind of a gold bug, you have to be there for that year. So we just have to figure out when that year is.
Yeah, absolutely. How about, do you have any rules around taking profits so that you can not necessarily even maximize, but, appreciate some of the gains that you are making instead of riding it back down the other side?
Yeah, these are such volatile stocks. Okay, speaking of the smaller gold and silver miners, okay, because that's where you really have to pay attention to taking something off the table and everything. So I just have a basic rule for that: is when something like that doubles, I just take my original investment out, and then I let the rest run, unless some really dramatic thing happens with the story to change it one way or another. But otherwise, I just let it run. And it's psychologically much easier to let house money run than your personal money. And once you've taken out your original investment, what's left is somehow not quite yours. And if it round trips you and you lose everything, it's psychologically easier to handle. And then if it goes way up, you might want to do the same thing again. Take out the original and let the rest run. But there's a few like that, like Snowline Gold, to just give one example there, has just been running for a really long time. And you could have taken out your first double, and then maybe you want to take out that double again, because it's just kept on going up. But there is no hard and fast rule, and there's no substitute for understanding the company too. So you want to pay attention to their drill results, to who's making strategic investments, to what's happening in their jurisdiction. Mexico is an issue right now for a lot of silver miners, for instance. And that's an issue if you've got a little Mexican exploration company. You need to be paying attention to what the Mexican government is saying about mining stocks and stuff like that. But yeah, with the bigger companies in this space, there's no real reason to sell any of a well-managed big gold or silver miner, because they're in a bull market. They'll fluctuate along the way, but they're going to pay you a pretty decent dividend. Probably they're going to buy back stocks, and as long as they are generating plenty of free cash flow, just let them ride. Don't really try to get cute with it at all.
Mm-hmm. What's happening in Mexico? Fill us in there. Are they re-threatening to go against open pit mining there?
Well, the current government of Mexico, the party that's in charge, it has issues with the way foreign companies have divided up the profits in the past with mining. And they want a bigger cut for themselves. They want more control over their own natural resources, which is a totally understandable attitude. But they're doing things that might make it a lot harder for miners to turn a profit there. And they're threatening, nationalization of some of the resources and stuff like that. So Mexico used to be a really good jurisdiction, and it's still the biggest silver producing country in the world. They produce twice as much silver in Mexico as the second place country, which is China. So that's a very big deal for silver miners. Everybody's got a Mexican mine. And right now it's not clear what they're going to do. They could just cut a slightly better deal and then go back to the old way of doing business, or they could basically want to take over their own resources and run them with nationalized companies, that are like Petrobras or something like that in Brazil, where they're kind of owned and run by the government. And, there's no way to know. But you want to pay attention to that. Jurisdiction is really important. And Canada is not even such a good jurisdiction anymore, apparently, because Canada used to be the best jurisdiction. And so we're running out of really prime jurisdictions. We're basically down to like Nevada or something there now, which is like a AAA jurisdiction. There just aren't that many countries out there where you can be just totally comfortable and don't have to pay attention to what the government is doing. So that is an argument for just owning physical, by the way. If you just own physical metals stored in a safe place, you don't have to worry about what Mexico is up to. In fact, Mexico, if they expropriate all their silver assets, that's great for you if you own physical silver, because it'll make the price of silver go up. So jurisdiction cuts both ways, and you have to think about how you want to address it via equities and physical and stuff like that. And, another intellectual challenge.
John, you had a line at the end of one of your recent articles that I thought was excellent. It said, "This is an opportunity, not a crisis." So what other hard assets or, tangible things are you looking at investing in right now?
Well, uranium is a great story because right now AI looks highly likely to need a lot more electricity going forward, along with electric cars and the rest of the electrification thing that we want to do. Every big country wants to electrify, and the current power grids are totally inadequate for the world as people envision it 10 or 20 years from now. So we need more power. And nuclear, problem with nuclear is that every 10 years a nuclear plant melts down. Then nobody wants to touch that energy source for the next 8 years. But a lot of countries are concluding that was a mistake, and they want to, bring back mothballed nuclear power plants or line up a bunch of new ones, and that's going to lead to a big demand going forward for uranium. And that makes the uranium miners really interesting. So that's one place in the commodity universe that is probably relatively safe with pretty good upside. Copper, kind of a similar story. We don't make anything like enough copper to electrify the world on a scale that we're talking about doing. And it's really hard to open a new copper mine right now because they are big. Copper is kind of, it has a small per price value or per pound value, which means you got to take a lot of copper out of a mine to make any money at it. And your mines have to be really big. And they're because of that, they're unpopular. So it's not clear how we get the copper that we need over the next 10 years. And it's also really, it's also a really positive thing for the copper mines that exist right now. It's not clear where we get the copper we're going to need, which makes today's operating mines more valuable than they probably seem right now. So, a copper miner ETF or something like that is probably a really good, fairly safe place to put some money. Again, with the potential recession in the next year in mind, because all commodities could have a tough 6 months or tough year because we're having a recession. But that's not a longer term problem for these guys. If their price goes down from here, that just means less will be produced and the price will go up more when the market turns. Let's see what else. Well, obviously oil and gas and things like that. We're going to continue to use petroleum. And natural gas has been extremely cheap compared to oil. So, oil is going to be in demand going forward. Natural gas is also going to be in demand, and it's pretty cheap. So you could look at gas pipeline companies and the best run oil companies. Those are all pretty relatively safe things to be in right now. And a lot of them pay pretty good dividends too. So there's a lot in the commodity space that's interesting, as long as you're careful in this kind of a world. Heading into a recession, you want to go with quality, and don't try for 10 baggers unless you have some kind of information that or special understanding that allows you to do something like that with certainty. Otherwise, just be safe, dollar cost average, go for dividends, go for stock buybacks, and then watch the overall market.
Mm-hmm. Sound advice there, John. And there is so much going on, but I think the undervaluation and underperformance of many of these commodities and the fundamental picture has not changed. If anything, it's gotten better. Is there anything else that you'd like to leave our listeners to think about today? There's so much that you and I actually touched on before we hit record here today. Is there anything that you think that, other than what we've talked about, that they should think about?
Well, yeah, the idea of resilience, which is the point of investing in commodities and things like that, that's way broader than just an investment thesis. There should be a lot of things. There are a lot of things we should be doing with our lives to make ourselves more resilient. And one is own a little piece of land and grow some food on it. Other is skill stacking, where you learn how to do some things that might have survival value in stressful times. And with your community, you want to be surrounded by people, ideally, who you trust and who trust you and can help each other out in stressful times. And a lot of us have done the opposite over the past 20 or 30 years. We've assumed everything would be okay. And we've moved around a lot, and we've got some family here and some family way over there and some friends over here, but not that many people in the neighborhood anymore. Things like that. That's not a resilient kind of life. So you want to embed yourself as much as possible into your community, so people and people have your back. And I think that's good advice for just life in general, right? But it becomes more useful, more necessary when you head into really stressful times, which we definitely are now.
Yeah, absolutely. And that idea of building resilience, both financially and in life, I think is extremely important. It's something I've been thinking a lot more about lately. But for anybody that wants to read more of John's work, that's all available at rubino.substack.com. Excellent follow there, John. You've really curated a really good and interesting collection of work there. Is there anywhere else you'd like to point to for people?
No, that's my only project now. Yeah, it's at rubino.substack.com, and it's a newsletter that aims at resilience. What can we do to prepare ourselves kind of across the board for interesting times?
Absolutely. John, thanks so much for your time today. I always appreciate it.
Thanks, Don. Talk to you soon.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.